Picture the pitch. No factory. No inventory. No shipping. Somebody else already designed the product, already built it, already sold it to the customer standing in front of you. All you have to do is ask one more question after they've paid. Would you like to add protection? That question, asked in the 2 seconds right after someone hands over their money, is one of the highest margin sentences in modern retail. Not a guess. The business. $147 billion. That's roughly the size of the global extended warranty industry in 2025. Plans layered on top of laptops, refrigerators, cars, phones, sold on a single promise. If it breaks after the manufacturer stops covering it, someone else will pay to fix it. Here's the part nobody says out loud at the register. The company selling you protection against the product failing usually makes more money from the piece of paper than the store made from the product itself. And it's not slowing down. Multiple industry forecasts put the category's growth rate somewhere between 6% and 12% a year through the early 2030s, faster than the retail sectors selling the underlying products. More cars are being sold with embedded electronics that are expensive to fix. More appliances are being sold as connected devices with components nobody local knows how to repair. Every one of those trends makes the pitch at checkout land a little harder than it did 5 years ago. That's the illusion. Here's what's actually underneath it. Under U.S. federal law, only the original manufacturer is allowed to call something a warranty. Everything a retailer, a dealership, or a random company on late-night TV sells you afterward is legally a service contract. Different name. Different rulebook. Far less regulation attached to it. Nobody selling it corrects you when you call it a warranty. It's better for business if you don't know the difference. The category itself keeps growing. Standard protection plans, coverage for ordinary mechanical or electrical failure, make up close to 60% of the global market. The rest is accidental damage coverage, the plan that pays out when you drop the phone, not when it simply stops working on its own. North America alone accounts for more than a third of the worldwide total. Now here's the part that actually matters. Almost nobody who sells you the contract is the one who pays your claim. Walk the chain from the counter backward. The person pitching you at checkout, the retail clerk, the finance manager at the car dealership, is a distributor, effectively working on commission. Behind them sits an administrator, a company that designs the contract's terms, sets the price, and processes claims when they come in. Behind the administrator sits an insurance company, the entity actually on the hook if your product breaks and the claim gets approved. And increasingly, behind the insurer sits a reinsurance structure, sometimes one the dealership itself quietly owns, built purely to capture a slice of the underwriting profit before it ever leaves the building. For layers, sometimes 5. Every one of them takes a cut before a single technician ever looks at your washing machine. This is why the pitch sounds rehearsed. It is. Names like Assurant, Assurian, AIG, and Allstate's SquareTrade sit quietly behind a huge share of the plans sold under a store's own logo. Buy a protection plan with a familiar retailer's name stamped on the folder, and in practice, you're often buying an insurance product from a company you've never heard of, wearing a name tag you recognize. And here's what that means once you actually understand it. The plan in front of you was never priced around your specific product's real chance of breaking. It was priced around an actuarial model built by an insurance company, sold through a distributor whose incentive is volume, not around whether your particular washing machine is actually likely to fail. There are really 3 separate doors this product walks through to reach you, and each one changes the pitch without changing the underlying math. Door 1 is the retail counter, the electronics store, the appliance dealer, the register clerk trained to ask the protection question on every transaction. Door 2 is the car dealership finance office, where the plan gets bundled into a monthly payment small enough that a buyer barely notices it changed. Door 3 is the direct-to-consumer marketer, companies that skip the retailer entirely and sell straight to you through television ads and outbound calls, the ones promising your car's warranty may be expiring before you've even checked. Different door, same 4 layers waiting on the other side. Here's a question worth asking before we go further. If the math so clearly favors the seller, why do so many people still say yes? Researchers studying real purchase data from a large U.S. electronics retailer found part of the answer In something simpler than a spreadsheet, people don't judge risk the way actuaries do. On television specifically, the same research found the true failure rate sits below 7%, while the warranty price charged routinely exceeds 22% of the television's own price. Run that math and the retailer's built-in margin comes out near 67% on a risk that, statistically, almost never materializes. Consumers weren't buying based on the real odds. They were buying based on how a small, certain cost feels less painful than an uncertain, larger one, even when the numbers say the uncertain outcome was unlikely all along. Automobiles are the single largest slice of the category worldwide, accounting for roughly 40% of global extended warranty revenue, more than electronics, more than appliances, more than every other product type combined. That's not because cars break more often than phones. It's because a car repair bill is large enough that the fear of it is easy to sell, and the payment can be folded into a monthly auto loan a buyer barely notices growing. Behind almost every one of those car dealership contracts, and behind most of the official-looking plans sold at electronics counters, sits a short list of the same handful of underwriters, repeated across thousands of storefronts that look nothing alike. Assurant, Assurian, American International Group, Allstate, through its SquareTrade brand. A car dealer in one state and an electronics chain in another can be selling contracts backed by the exact same insurance company, priced by the exact same actuarial team, with two completely different logos printed on the cover page. The retail experience is local. The financial engine behind it is not. The regulatory picture looks different depending on which side of the Atlantic you're standing on. In the United States, service contracts are regulated state by state, unevenly, with federal oversight limited mostly to truth in advertising enforcement after the fact. In the European Union, regulators have moved the other direction. Proposals for mandatory minimum warranty periods baked directly into consumer law, shrinking the very gap that the extended warranty industry exists to fill. Two different responses to the same underlying question. Who should be financially responsible when something breaks, the manufacturer by default, or the consumer by opt-in purchase? The first wall you hit isn't money. It's paperwork. Nearly every U.S. state regulates service contracts as a form of insurance, which means registering as a provider, backing every contract with either an insurance policy or a funded reserve account, and in many states, posting a bond. That's before you've sold a single plan. The second wall is that you almost never underwrite the risk yourself. You outsource it to an administrator who prices the contract and an insurer who stands behind it, which means your margin isn't set by how well you run your business. It's set by what they're willing to hand you. None of that paperwork is free, and none of it is fast. Registering as a service contract provider typically means separate filings in every state you plan to sell in, a contractual liability insurance policy, or a funded reserve trust to prove you can actually pay claims, and in a meaningful number of states, a surety bond on top of that. Money set aside purely to prove you're solvent before you're allowed to collect a single premium dollar. A company launching a national program is effectively pre-funding its own credibility in 50 separate jurisdictions before its first sale closes. And that's where the layers start stacking. A typical retailer's profit margin on the actual product, the laptop, the TV, the appliance, runs somewhere around 15% to 20%. Move to the extended warranty sold next to it, and margins commonly run 40% to 70%. Push further into the best negotiated programs at the biggest chains, and some analysts have put realized profit above 200% of cost, 15 to 20, then 40 to 70, then over 200. Three thresholds, one direction, away from the product, toward the paper. Meanwhile, there's a second escalator running in parallel, not price, but participation. Industry-wide, the average store attaches a protection plan to somewhere around 15% to 20% of eligible sales. The better-run programs push that above 35%. The best individual sales reps, on their best days, have been recorded closing nearly 58% of eligible customers. Higher attach, higher margin. Same store, same product, wildly different profit, depending entirely on how well the pitch is delivered at the register. Now for the hidden costs, the ones buried on page 4 of a contract nobody reads before signing. One side of the calendar is the manufacturer's warranty, which typically runs 12 months and covers exactly the period when true manufacturing defects tend to surface. The failure curve is steepest early and flattens fast. The other side of the calendar is the extended plan, which mostly kicks in during year 2 and year 3, precisely when that same failure curve has already gone flat. You're paying a premium to insure against a risk that's already declined by the time your coverage even starts. Then come the exclusions: wear and tear, pre-existing condition, improper maintenance, cosmetic damage, categories broad enough that an adjuster can fit almost any denial inside one of them. Deductibles stack on top. Cancellation policies are written to return less than you'd expect, calculated on a sliding scale that favors the seller. Try to cancel one of these contracts partway through, and the fine print usually splits into two different math problems, and neither favors you. Cancel early, within a short initial window, and you're typically entitled to something close to a full refund. Cancel later, after that window closes, and the refund shrinks on a curve that isn't linear. Administrative fees come off the top first, and what's left is often prorated against the contract's face value rather than what you actually paid for it, which can already include the retailer's markup. The seller collected their margin the day you signed. The refund math is calculated as if that margin never existed. Only 20% to 30% of people who buy one of these contracts ever file a claim at all. That single number is the real business model, not the repairs. The premiums nobody collects on. And for the smaller share who do file, the hidden cost isn't finished. Industry tracking sites and consumer dispute services report that somewhere between 30% and 50% of initial claims get denied on the first attempt, and separate analyses of lower quality providers put denials as high as 43%, often on exclusions technical enough that a first-time reader wouldn't catch them in the contract. Not every denial is wrong, but the incentive on the other side of that decision is never neutral. Every dollar not paid out on a claim is a dollar of margin the administrator or insurer keeps. Regulators have noticed. The Federal Trade Commission has repeatedly taken enforcement action against operators in this category for deceptive marketing. Robocalls implying a manufacturer relationship that doesn't exist, mailers designed to look like official recall notices. One of the larger recent examples, a $10 million settlement in 2024 against a widely advertised auto service contract marketer over allegations that its ads misrepresented what the plans actually covered. Enforcement after the fact doesn't return money already spent. It also doesn't slow down the next mailer landing in somebody else's mailbox next week. Start with the price you're quoted. Industry data on dealer-sold vehicle service contracts shows dealers commonly marking the product up 50% to 200% above what the administrator charges them, meaning at least half of what you pay is markup and margin, not risk transfer. Compare that to the profit a dealership makes on the actual vehicle. New car front-end gross profit has averaged a few $1,000s per sale in recent years, while a single well-sold service contract can add a comparable amount of pure profit on paperwork that took minutes to sign. On electronics and appliances, the split runs differently but lands in a similar place. Retailers keep a spread that routinely outperforms the profit on the hardware itself by 2 to 5 times. Back in 2003, analysts estimated that extended warranty sales accounted for nearly half of Best Buy's total operating income that year, off a product category most shoppers barely think about on their way to the register. Nearly half of a major electronics retailer's profit, from a category that isn't the electronics. Think about what that actually implies for how a store gets run. If protection plans are contributing that much to the bottom line, then the register clerk asking you the protection question isn't performing a customer service script. They're performing the store's second business, running in parallel to the first, invisible on the shelf, visible only on the internal sales dashboard that tracks attach rate by employee, by shift, by store. Here's the mechanism that makes that possible. An insurer prices a service contract program to hit a target combined ratio, claims paid out plus operating expenses, measured against premium collected, usually aiming to keep that ratio around 80% to 90%. In plain terms, for every dollar collected in premium, the insurer expects to pay out somewhere between 50 and 76 cents in actual claims over the life of the program. Keep the rest as margin, and earn investment income on the reserves sitting in the account in the meantime. The retailer or dealer then adds their own markup on top of that already profitable insurance price. That combined number, insurer's price plus distributor's markup, is what shows up on your receipt. And there's a third layer that most customers never even hear the name of: reinsurance. A dealership with enough volume can set up its own reinsurance company, sometimes called a producer-owned reinsurance company, and route a portion of the underwriting profit and investment income from every contract it sells back into that entity, which it owns. Dealers who skip that step are, in effect, handing six-figure annual profits to somebody else's balance sheet for no reason other than not having set up the paperwork. 3 profit layers, stacked on top of each other. The distributor's markup at the counter. The administrator's fee for running the program. The reinsurance reserve, quietly compounding, owned by whoever thought to claim it. None of those 3 layers requires fixing anything. None of them requires a warehouse, a truck, or a technician. The entire machine runs on collected premium sitting in an account, waiting, statistically, and by design, to mostly not be needed. Smaller electronics retailers run the same arithmetic at a different scale. One documented case among independent consumer electronics sellers showed hardware margins sitting at just 3% to 7%. Thin enough that a single bad quarter could wipe out profit entirely, while the protection plans attached at checkout converted on close to 28% of eligible sales on average, spiking as high as 58% for the best-trained staff, and lifted overall net profit by roughly 18% without changing the price of a single product on the shelf. The store wasn't more profitable because it sold better televisions. It was more profitable because it sold more paper next to the televisions. That's the part worth sitting with. In almost every version of this business, the actual product on the shelf is close to a break-even proposition, priced competitively enough that shoppers keep coming back, margin thin enough that one supply chain hiccup erases it. The protection plan is where the real operating profit lives, which means, structurally, the incentive to sell you the plan is often stronger than the incentive to sell you a good product in the first place. It started as National Auto Warranty Services, out of Wentzville, Missouri, founded by 2 brothers, Darine and Corey Atkinson. By the mid-2000s, it had rebranded as U.S. Fidelis, and it grew into the largest seller of vehicle service contracts in the country, pitched aggressively as extended warranties, even though federal law reserves that word for the manufacturer. U.S. Fidelis became a primary NASCAR sponsor, its name riding on Rusty Wallace's car, lending the whole operation a layer of trust that had nothing to do with how the contracts actually paid out. The sales machine behind that trust ran on volume. Telemarketing calls. Direct mail designed to look like it came from a car's actual manufacturer. Scripts telling consumers their factory warranty was about to expire, when in many cases it already had, or never applied the way the caller claimed. Growth on that model looks incredible right up until it doesn't. A company selling a financial promise instead of a physical product can scale distribution far faster than a business that has to build stores, hire technicians, or stock parts. All it needs is more phone lines and more mailing lists. By the time regulators started paying attention, U.S. Fidelis wasn't a regional operator anymore. It was the largest seller in its category in the entire country, its name on a race car, its call volume high enough that a single telecom carrier would later allege millions of illegal calls from that operation alone in under a year. That's the pattern worth remembering. The faster a company built on selling paper can grow, the less time anyone has to notice that the paper isn't fully backed. The economics behind a single sale tell you everything. A typical contract sold for more than $2,000. $1,200. That's roughly the profit U.S. Fidelis kept on a single one of those contracts. The company's own co-founder later admitted the number in a guilty plea. The contract administrator behind the plan took around 30% of the money. The company financing the customer's payments took another 10%. What was left, close to 60 cents of every dollar, went straight to the 2 brothers running the operation. State attorneys general began investigating in 2008. Verizon separately sued the company that same year, alleging more than 3 million illegal robocalls placed to cell phone customers over a 7-month stretch. The Better Business Bureau logged more than 1,400 complaints. By late 2009, the business had effectively collapsed under its own sales practices. On March 1, 2010, U.S. Fidelis filed for bankruptcy. More than 400,000 consumers nationwide had paid the company thousands of dollars each for contracts sold through what state investigators later called illegal and deceptive means. Attorneys general in at least 11 states eventually joined a coordinated case, accusing the company of violating do-not-call laws, using technology to mask caller ID, refusing to let customers review the full written contract before the sale closed, and improperly denying valid refund requests after the fact. Federal law is explicit that only a vehicle's manufacturer can call something an extended warranty. U.S. Fidelis marketed its product under exactly that phrase, to consumers who had no reason to know the distinction mattered, right up until the day the company stopped being able to pay for the promises it had already sold. What came after the collapse is its own case study in who actually gets paid last. Court filings accused the Atkinson brothers of personally diverting roughly $101 million in company assets, a 40,000-square-foot mansion, a 50-foot yacht, 10 other boats, 11 cars, 14 motorcycles. Under a bankruptcy settlement, they agreed to surrender at least 90% of their personal assets. Both brothers eventually pleaded guilty to insurance fraud, consumer fraud, and stealing. And here's the detail that tells you where the real risk in this industry actually sits. The company's largest creditor, a finance firm called MEPCO, had financed more than 650,000 of these vehicle service contracts. When the bankruptcy estate, worth roughly $25 million, was being divided up, MEPCO stood to collect most of it. Unsecured creditors sued MEPCO directly, arguing the finance company knew the entire structure carried, in their words, the elements of a Ponzi scheme, and kept financing it anyway because the fees kept flowing regardless of whether any individual contract ever got paid out on. The technicians never got a cut of any of it. Neither did the 400,000 customers holding a folder full of paper that a bankrupt company was no longer obligated to honor. Notice where the financing company sat in all of this. MEPCO never sold a single contract to a single consumer. It simply lent U.S. Fidelis the money to keep selling faster than incoming premium could support, collecting fees on every one of those 650,000-plus contracts regardless of whether the underlying promise was ever going to be honored. When the structure finally gave out, the company that financed the growth was positioned to collect first, ahead of the customers who'd actually paid for protection that, in many cases, they never received. Not the customer holding the contract. They're the one taking on real financial exposure, betting a few $100s now against a repair bill that, most of the time, statistically, they will never file a claim for at all. Not even the retailer or dealer at the front of the transaction. Not entirely. They take a real cut, but it's a small one compared to what sits behind them, and they carry real reputational risk every time a claim gets denied at the counter. The winners sit further back in the chain, in the layers most customers never see. The administrator who designed the contract's fine print wins regardless of whether claims run high or low, because their fee is built into the price before a single claim is filed. The insurer wins by design, targeting a combined ratio that guarantees underwriting profit as a starting assumption, not a hoped-for outcome. And the party that owns the reinsurance structure, whoever thought to set one up, wins twice. Once on the underwriting spread, and again on the investment income compounding quietly on premiums collected long before any claim comes due. While the person selling you the contract gets paid the moment you sign, the person who might eventually have to pay your claim gets paid whether or not your claim ever happens. Zoom out to the two regulatory regimes side by side, and the same asymmetry shows up at a policy level, not just a contract level. Where mandatory manufacturer coverage is longer by law, the entire optional layer of this industry is built on shrinks. There's simply less gap left to sell into. Where coverage defaults to the shortest legal minimum and enforcement leans on after-the-fact lawsuits rather than upfront limits, the gap stays wide open, and every layer of this chain gets to keep operating inside it. The industry isn't uniquely predatory in one country and virtuous in another. It's exactly as large as the space regulators leave for it to occupy. That asymmetry is not a flaw in the system. It is the entire system. Consider the two positions side by side. On one side, you, the buyer, holding a contract, hoping you never need it, aware on some level that if you do need it, someone on the other end has a financial incentive to say no. On the other side, for separate companies, none of whom manufactured your product, none of whom will personally hold a wrench if it breaks, each of whom already booked their portion of your payment as revenue the moment your signature landed on the form. One side is exposed to an uncertain future. The other side already got paid for it. So the next time you're standing at a register and someone leans in and asks that same 2-second question, would you like to add protection? The honest version of that question is a different one entirely. Are you protecting the product in your hands? Or are you funding somebody else's margin for layers removed on a claim that statistics say you'll probably never file? Is the paper actually for you? Or is it for everyone standing behind the counter you can't see?